Hello and welcome to Wednesday webinar. I'm Julia Hartman from the Bantax National Accountants Group, and in just 5 minutes I intend to explain to you some very important points regarding loans and keeping your interest tax deductible. First of all, why this is so important. If you're paying off non-deductible debt, in other words the interest isn't deductible, then you have to earn $1.50, pay tax on that $1.50 or 50 cents, and you get $1 to pay your interest. Whereas the interest on a loan that is deductible means that you don't pay tax on the money you earn, so you only have to earn $1 to pay $1's interest off a deductible loan. It's very important to be very careful. It saves you a lot of money over the years to get it exactly right. So the objective is to borrow 100% for an investment property, even if you have to use your own home as a bit of the security, and to keep that loan interest only until you've paid off all your non-deductible debt. Now, there are two main rules regarding interest and when it's deductible. One is the nexus, the tracing of the money that you borrow being put to a tax-deductible purpose. This is a very strict nexus. You need to be able to show that the drawdown went directly to a deductible use. For example, in John Jam's case, she took the money out of the loan account and put it in her personal cheque account to write a cheque to the builder for some repairs. Now, there was other funds, personal funds in that cheque account. The tax office was successful in arguing that she'd mixed it with personal funds, so there was no nexus, there was no connection between paying the builder and the drawing of the money. So part of that loan now was not deductible because it was private purposes. Now, a couple of don'ts. One of the traps I see happen quite a bit is people use cash for the deposit on an investment property. Remember before we said borrow 100% for your investment property. But the banks might say to you, look, it's going to take us a while to get the loan organised. Use your cash, and when we get the loan organised, pay yourself back. Well, that won't work because the nexus is lost, as I explained earlier. That money that you use to pay yourself back, that portion of the loan, the interest on that portion of the loan will not be tax deductible because the money has been used to pay for whatever you use it for when you pay yourself back, buy TV or whatever. So that's not related to the investment property. Once you've used the deposit in cash, it's very hard to change that back to borrowings. The only way I can think that it would work is if you ask the real estate agent to refund the deposit at settlement to you, and then the bank pay the full amount of the borrowings as the full purchase price. And that's still a problem getting them to do that. Okay. When selling off your own home, I've seen the banks park the proceeds in your rental property loan account. You may be between houses, so they could go, we'll put it there and save you some interest. Or you might have a bridging loan, and instead of paying the bridging loan, they mistakenly pay it off the rental property. In both cases, that's it. That loan is no longer deductible. It's been paid for. You can never borrow it back again to pay for that particular rental property. You've lost all the interest deduction on your rental property forever. No suggestions on how to fix that. So please keep an eye on what the banks are up to. Don't have your wages paid into a loan account that's non-deductible. Don't have your wages paid into a loan account that is deductible, because the time when you draw out to live on it is drawings for private purposes, but the deposit of your wages pays off the rental property. So eventually, in about 5 years, that loan becomes a non-deductible loan because it's had so much private drawings, not to mention the chaos of trying to work out the interest apportionment in the meantime. The big solution to all this cash floating around, like your wages and that, is to have an offset account rather than pay anything off the loan. So you've got a separate account, not a redraw facility. It must be an offset account, a separate account where you put your money into that, your wages or whatever, you draw out of that to pay your personal expenses. But if you've got $10,000 in that offset account and you owe the bank $100,000, they'll only charge you interest on $90,000. So you get the same interest benefit, but you've still got the flexibility of being able to use the money when it suits you. Now, I hope you've enjoyed that, and thank you very much for staying to the end. And every Wednesday, we'll have another useful webinar for you. Thank you. Bye.